Welcome dear students to the massive open online course on money and financial markets. In this module we will go through a brief history of the Indian money market. We will try to have a clear idea about the important players in the Indian money market, and then we would like to explore the defects that are there in the Indian money market. We all know that money market is a key component of the Indian financial system, and it is basically a market for short term funds with maturity ranging from overnight to 1 year, and it also includes those financial instruments that are considered to be very close substitutes of money. If we look at the history of the Indian money market, we find that till 1935, when the RBI was set up, the Indian money market had remained highly disintegrated, unorganized, narrow, shallow, and we can also call it very backward. The planned economic development, which started with the initiation of the first 5-year plan in 1950-51, marked an important beginning in the annals of the Indian money market. And then we had the nationalization of banks in 1969. Several committees were set up, such as the Sukhomoy Chakravarti Committee in 1982, the Vague Working Committee in 1986, the setting up of the Discount and Finance House of India Limited in 1988, and also 1991 marked the watershed year of Indian economy, when we had the commencement of the liberalization and the globalization process that was introduced in the Indian economy. All these had given a further fillip for the integration and efficient development of the Indian money market. In our previous module, we had already discussed about the various sub-money markets in the organized money market sector. The most important amongst them was the call money market. The call money market is the oldest in the history of money market in India, and it provides the institutional arrangement for making the temporary surplus of some banks available to other banks in the economy which are temporarily in shortage of funds. And the rate of interest that is paid on these call loans is known as the call rate. Till 1973 in India, the call rates were determined by the market forces. Due to the credit squeeze that was introduced by the RBI in May 1973 in the form of raising the bank rate and tightening of refinance and rediscounting facilities, the call rate had reached a very high rate of around 30% in December 1973. Due to this alarming level of call rate, it became utterly necessary to regulate it within a reasonable limit. And therefore, the Indian Banking Association, or the IBA, in 1973 fixed a ceiling of around 15% on the level of the call rate. Since then, the IBA has been lowering the ceiling of 15% to around 12.5% in March of 1976, to around 10% in June of 1977, to around 8.65% in March of 1978, and again to 10% in April 1980. In India, the call rate had always exceeded the bank rate except during the freak year of 1955-56. The difference between the two rates increased as the RBI tightened its refinancing and rediscounting facilities. Till 1975-76, the call rate was much higher than that of the bank rate. After 1981, the call rate was not very much but slightly higher than the bank rate. After Discount and Finance House of India Limited commenced its operation in the Indian economy from April 1988, it was permitted by the RBI to act as an arranger of funds in the call market. However, with effect from 28th July 1988, it has been allowed to participate both as a lender and as the borrower in the call notice market. The call rate has been freed from administrative ceiling in 2 stages. Effective from October 1988, the operations of DFHI in the call market were exempted from the ceiling of the call rate. And with effect from 1st May 1989, the callings in the call rate and the interbank term money rate were withdrawn. As a result, the call rate is freely determined by the forces of the demand for and supply of the call loan. There are now 2 call rates in India. One is the interbank call rate and the other is the lending rate of DFHI in the call market. Next, we focus our attention to the most important players who constitute the money market. In the Indian money market, the main borrowers of short-term funds are mainly the central government, the state government, the local bodies such as municipalities, the village panchayats, etc., the traders, the industrialists, the farmers, the exporters and the importers, and lastly the general public. Let us look at all these players one by one. Now, the central government. What is the role of the central government? The central government is basically a borrower in the money market. It tries to issue the Treasury Bills, and the government of India or the central government issues these Treasury Bills through the RBI. The Treasury Bills represent zero risk instruments. They are issued with tenure of 91 days, around 3 months, 182 days, around 6 months, and 364 days, that's around 1 year. Due to its risk-free nature, the banks, corporates and many such institutions, they buy the Treasury Bills and they lend it to the government as a part of their short-term borrowing program. The next in line is the public sector undertakings. Many government companies have their shares listed on the stock exchanges. Now, since they are listed on the stock exchanges, they can issue commercial papers in order to obtain the finance for their working capital. So, we can say that PSUs are generally only borrowers in the money market. They seldom lent out their surplus funds to others, and this is mainly the reason for it is mainly that they do have a bureaucratic mindset. The treasury operations of the PSUs are very inefficient. They have huge cash surplus remaining for a quite long period of time, and they could have easily lent it out, but they don't do that because of their high amount of inefficiency. The next in line is the insurance companies. We can say that both the general and the life insurance companies, they are also usually lenders in the money market. They are all cash surplus entities and they do not need to borrow from the money market. With the introduction of CBLO, that is collateralized borrowing and loaning and lending obligations, these entities, the insurance companies, they have become big investors. In between the capital market instruments and the money market instruments, the insurance companies invest more in capital market instruments. This they do so because their lending programs are generally for a long period of time, while we know that in the money market you need to have only, you can only lend for a very short period of time. So, for the insurance companies, their role in the money market is considerably lower than their role in the capital market. The next one we have in line are the mutual funds. Mutual funds offer a variety of schemes for different investment objectives of the public. We know that in the mutual fund segment category, there are many schemes. One of them is known as the money market mutual fund schemes, or they are also called liquid schemes. The main objective of these liquid schemes is to invest in money market instruments. They ensure the highest liquidity to the investors by offering withdrawal by way of a day's notice or by encashment of units through the bank ATMs. Naturally, the mutual funds invest the corpus of such schemes only in the money market. They do not borrow, but they only lend or invest in the money market. Banks, these are scheduled commercial banks. They are big borrowers and lenders in the money market. They borrow and lend in the call money market, in the short notice market, in the repo and the reverse repo market. They also borrow in rediscounting market from the RBI and also from development financial institutions like the IDBI. They lend in commercial paper market by way of buying the commercial papers issued by the corporates and the listed public sector units. They also borrow through issue of certificate of deposits to the corporates. Next, we talk about the corporates. What do the corporates do? The corporates borrow by issuing commercial papers, and these commercial papers are basically nothing but short-term promissory notes. They are issued by these companies which are listed after obtaining the necessary credit rating for these commercial papers. They also lend in the CBLO market their temporary surplus when they find that the interest rates are quite high in the market. The corporates are also lender to the banks when they buy the certificate of deposits which have been issued by the banks. In addition, the corporates are the lenders through the purchase of Treasury Bills. So, like this, there are various other small players like non-banking financial companies, primary dealers, provident funds and pension funds. They mainly invest and borrow in the CBLO market in a very small way. The defects of the Indian money market are as follows. We can say that a well-developed money market is really a necessary precondition for the effective implementation of the monetary policy of an economy. We know that for any economy, the central bank regulates and controls the money supply in the country through the operations of the money market and through the operations of several money market instruments. But unfortunately, the Indian money market is inadequately developed, it is loosely organized, and it suffers from various weaknesses. The most important defect that we find in the context of the Indian money market, predominance of the unorganized sector. The indigenous bankers or the money lenders, they do occupy a significant position in the money lending business in the rural areas of the country. In this unorganized segment, there is no clear-cut distinction between short-term and long-term and also between the purpose of the loans. These indigenous bankers, and they are a huge portion of the Indian money market, they are within or outside the purview of the organized sector. Therefore, they seriously restrict the Reserve Bank's control over the money market since they are outside the purview of the RBI. There is also a dichotomy between the organized and the unorganized segment of the Indian money market. Now, we can also consider this to be a very important defect of the Indian money market because of its division into two sectors, the organized sector and the unorganized sector. There is little contact, coordination and cooperation between these two sectors, and in such conditions it becomes extremely difficult for the RBI to ensure any sort of uniform and effective implementation of the monetary policy which is instrumental in operation in both the sectors. Another very important defect is that of an absence of an all India money market. The Indian money market has not been organized into a single integrated all India money market. It is basically divided into small segments. Most of them are catering to the local financial needs. We know that, for example, if we take this into consideration, there is little contact between the money markets in the bigger cities like Mumbai, Madras, Calcutta with those of the money market in the smaller towns like Nagpur, Pune and so on. Next in line is another important one, important defect of the Indian money market, the inadequate banking facility. Indian money market is inadequate to meet the financing needs for the economy. Although we have seen in the last few years, due to the stress on financial inclusion by the central government, there has been a rapid expansion of bank branches in even the rural areas of the country. But still we find that there are many places, many areas without any branches or banking facilities. As compared to the size and the population of the country, the banking institutions prevalent in the economy are not adequate to meet the financial needs of the country. Shortage of capital is another very important point in the context of the defect of the money market. Indian money market generally suffers from the shortage of capital funds. The availability of capital in the money market is insufficient to meet the needs of industry and trade in the country. There has been various reasons that has been cited for the shortage of capital. They are obviously the first and the most important one is the low savings capacity of the Indian people. And low saving capacity basically originates from the fact of low level of per capita income of the Indian people. Secondly is inadequate banking facilities, as I have already said, and these two particularly in the rural areas. Thirdly, there is an undeveloped banking habits amongst the people, and this also leads to shortage of capital. We know various people who do have money, but they do not really want to keep those money in their bank accounts, rather they would like to keep it in their houses itself. So because of this undeveloped banking habit, the shortage of capital is created in the Indian economy and in the Indian money market. What we generally notice in the Indian economy is a seasonal shortage of funds. So a major drawback of the Indian money market is the seasonal stringency of credit and higher interest rates during certain particular parts of the year. Such a shortage invariably occurs during the busy months from November to June, when there is excess demand for credit for carrying on the harvesting and marketing operations in agriculture. As a result, the interest rates during this period generally rises because there is huge demand for funds or credit. On the contrary, during the slack season, particularly from July to October, the demand for credit and the rate of interest also decline sharply. Another important feature is the diversity of interest rates. This is a glaring defect of the Indian money market because of the multiplicity and disparity of the interest rates. In 1931, The Central Banking Inquiry Committee wrote the fact that a call rate of 3/4%, a hundi rate of around 3%, a bank rate of around 4%, a bazaar rate of small traders of 6.25%, and a Calcutta bazaar rate for bills of small trader of 10% can exist simultaneously indicates an extraordinary sluggishness of the movement of credit between various markets. We find that the interest rates differ in various centers like Bombay, Calcutta, etc. These variations in the interest rate structure are largely due to the immobility of credit because of inadequate, costly and time-consuming means of transferring money. Disparity in the interest rates adversely affected the smooth and effective functioning of the money market. And then we have an absence of the bill market, because the existence of a well-organized bill market is extremely essential for the proper and efficient working of the money market. Unfortunately, in spite of various serious efforts that were made by the RBI, the bill market in India has not yet been developed fully. So, we have been talking about the defects of the Indian money market. So, now I think that we can look at what basically makes up for the undeveloped nature of the Indian money market. The Indian money market does not possess highly developed and adequately developed banking system. 2. It lacks sufficient and regular supply of short-term assets such as bills of exchange, treasury bills, short-term government bonds, etc. 3. There is no uniformity in the interest rates, which vary considerably amongst different financial institutions as well as in different cities. Number 4. In the Indian money market, there are no dealers in short-term assets who can function as intermediaries between the government and the banking system. 5. No doubt, a well-developed call money market do exist in India, but there is absence of any other sub-money markets such as say the acceptance market, the commercial paper market, the commercial bill market, etc. All these are virtually underdeveloped or absent in the context of the Indian economy. There is no proper coordination between the different sectors of the Indian money market, and lastly, the Indian money market does not attract foreign funds and thus lacks an international status. So, what can be done to improve the Indian money market? The activities of the indigenous banks should be brought under the effective control of the RBI. There should not be indigenous bankers under the unorganized money market. Everyone should come under the organized segment under the purview of the Reserve Bank of India. Hundis used in money market should be standardized and written in an uniform manner in order to develop an all India money market. The banking facilities should be expanded, especially in the rural, unbanked and neglected areas. Discounting and rediscounting facilities should be expanded in a big way to develop the bill market in the country. For raising the efficiency of the money market, the number of the clearing houses in the country should be increased and their working improved. Adequate and less costly remittance facilities should be provided to businessmen to increase the mobility of capital. And lastly, the disparity or the variations in the interest rates that are observed in the Indian money market should be reduced. So, if the government takes these steps to ensure proper development of the Indian money market, then of course it would be a very good and a very important step in the financial development of the entire economy.